Hi everyone, this is Matt with the Fundamental Investing Institute. Thank you for tuning in. We are continuing our video series on the history of the Federal Reserve. In the last video, we discussed the crash of 1929. This begins in September and kind of continues throughout the fall. But in the fall of 1930, the economy looked as if it was beginning to improve, and many people were expecting a robust recovery. This is when the banking panics begin, and it is the banking panics that exacerbate the recession after the crash into the Great Depression. Now, I should say two things about the banking system at this time. Number one, there were thousands of banks, in fact, approximately 24,000 banks in the United States in 1930. Only 8,000 of those banks were members of the Federal Reserve System, the 12 Federal Reserve banks spread throughout the country. That leaves 16,000 smaller banks that could not access the Federal Reserve's discount window lending in times of crisis. Those banks had to rely on larger banks in order to get liquidity. So it was a remnant of the national banking system for those 16,000 banks, a significant portion of the U.S. banking system. Those banks couldn't access credit because the larger banks were under no obligation to extend credit. The second thing we need to note is that the country did not yet have deposit insurance. And this meant that bank runs were a common feature of the U.S. banking system. A bank run, of course, is when depositors en masse try to take back their deposits out of the bank. And because banks do not keep all of those deposits as reserves, they only keep a portion of them. When depositors do a run on the bank, it threatens the solvency of the bank. So this is what is happening throughout the 1930s. The banking crisis of 1930 started with the collapse of a company called Caldwell Company. This was the largest financial conglomerate in the southern United States. Several of Caldwell's executives had been pretty much wiped out in the stock market crash, and they were draining the cash of the subsidiary banks of Caldwell in order to help cover their losses. This put the solvency of those subsidiary banks in question, and in fact, it led to the collapse of several. Those failures, the failures of the subsidiary banks for Caldwell Company, in turn spread to other banks throughout the South and the Midwest. Now, in December of 1930, the Bank of the United States, this is a bank in New York, it was New York's fourth largest bank, collapses in December of 1930. It faces a major run, collapses shortly thereafter, and it particularly hurts the immigrant community in New York who had relied on the bank thinking that it was affiliated with the United States government. In June of 1931, another banking crisis erupted, this time in Chicago, with banks that were heavily exposed to speculative real estate. Now, the event that really begins to turn regional banking crisis into a national banking crisis is in September of 1931, when Great Britain leaves the gold standard. Great Britain suspended gold convertibility of their currency, and fears that the United States would follow led foreign depositors to demand conversion of their dollar assets to gold. This drains gold out of the banking system, and it leads to the insolvency of many institutions. Depositors also are concerned about bank solvency at this point, and they're converting their deposits to currency as well. So you have both an external drain from the foreign depositors converting their dollar assets to gold, and you have an internal drain from depositors, domestic citizens that are converting their deposits to currency. This leads to a sharp reduction of the money supply. Now, to exacerbate those problems, the Federal Reserve Bank of New York actually raised the discount rate to try to stem the flow of gold out of the United States. This is another action that contracts the credit, tightens credit conditions throughout the country. Now, in 1932, Congress really begins to react by creating the Reconstruction Finance Corporation, or the RFC. The RFC initially has a mandate to lend to different financial institutions on relatively attractive terms. The mandate of the RFC gets widened throughout the Great Depression. It becomes a very important institution used to help finance liquidity throughout the crisis. But another issue is another thing that the Fed does, the Federal Reserve does, is it engages in roughly $1 billion of open market purchases. This means that they're buying securities from banks and they're increasing the reserves of those banks in the process. They do this between April and August of 1932. The actions of the RFC and the open market operations of the Fed start to help credit conditions, things start to improve. But in late 1932, another wave of bank failures hit the West and the Midwest. And then by early 1933, you pretty much have a national banking crisis. States are starting to enact bank holidays. And of course, one of the first actions in March of 1933, when Roosevelt comes to office, is to enact a national bank holiday. We'll end there. In our next video, we'll discuss some of the responses that the incoming Roosevelt administration does to try to combat the Depression.